Welcome, guys, to episode number 1 of the Genesis Block podcast. Today, we are here analyzing, or I should say, um, evaluating how to analyze a protocol, a Web3 protocol, right? So let's just dive right into it. I'm gonna kick things off with giving a brief on how one should, kickstart their journey on evaluating a protocol when they just come across it. And of course, guys, Yash, Sid, feel free to hop in and add your thoughts wherever you all deem fit, right? So
Definitely.
yep, let's get into it. So okay, so when you just come across a new protocol, right? What do you do? Right. So what I would do at least is first just understand what the problem the protocol is trying to solve, right? Um, Usually, I'm not usually, but at least now in the current state of the market, you see a lot of Me Too protocols, doing the same thing over and over again. And if you at least double click on the NFT space, and most of them are not doing anything, right? So this is the first step is just figuring out what is it trying to solve for. That should help you really filter down the protocols where you spend your time on going forward. So yeah, so first, what is it trying to achieve, right? And then this will give you a pretty good idea on where it really fits in the broader landscape of Web3, really. And Web3 is massive. I mean, there's like Web3 crypto is not. It's an understatement to call it an asset class, because there are various sectors and subsectors within crypto itself, right? There's finance, there's gaming, there's art, there's infrastructure as well, right? So there's everything. So just trying to understand what problem it's trying to solve for will help you gauge where it fits in this whole ecosystem, right? What are some examples of said sectors? Well, um, well, to begin with, you can always classify it as three things, if I'm not mistaken. Right? You have the infrastructure layer, which I would comprise everything that you need for an application, or even an L1 to exist, right? In some cases. So you have infrastructure, then you have the layer 1, which has all the applications on top of, and then you have the application layer itself, right? So these are, of course, these categorizations are very subjective, but they help me understand it at least, right? So yeah, so we have layer 1s, and then of course you have layer 2s on top of them. That's one bracket which is helpful, one mental model that's good to keep. Then you have decentralized finance. So these are the whole host of applications that are built on these L1s and L2s. You have gaming, that's, or play to earn gaming, right? That's another set of applications built on these layer 1, layer 2 protocols. Then you have exchanges, right? So that's also like almost a primitive that fits in, that can fit into multiple categories. Would be, some might call it DeFi, but it's very fundamental to justify its own category, I would say, right? So yeah, so then you have DAOs, which are quite interesting. These are Web3's iteration of the corporation, really. How people coordinate to create value, right? So that's another whole. I mean, in a way, it's an application as well of Web3 technologies, but it's unique enough to merit its own sector. Then you have infrastructure, right? I briefly mentioned. So what fits here? So I mean, a lot of things. So that make a lot of things that make the whole user experience of when they are interacting with Web3 better, right? So a very, very fundamental, which I'm sure all of us would agree, is the wallet, right? The wallet is the gateway to basically everything in Web3, right? Without a wallet, you can't do anything. And and to give you an example, right, a wallet is sometimes, I mean, by a lot of people, you know, they use the analogy of a passport, right? And the passport is like the passport is a gateway to the world, right? Wallets are the gateway to the entire Web3 ecosystem. It has your currency, like the value you spend. It also has your identity. It has and as a derivative of that, it has your reputation. Maybe not now, but soon it's in the works, and you can see that that's the direction we're going towards. It has your art, right? Like, I mean, currency could mean your liquid currency, which your money really you spend, but it also has various other asset classes. Bitcoin could be one of them. It's a hard money, right? It's a sort of value. Whereas it can also be NFTs, it can be a digital art, right? So everything really resides in your wallet and gives you access, right, to the various crypto and Web3 protocols, right? So then that's just one, right? Then you have oracles. Those are quite interesting. How does a blockchain, right? How does any blockchain really, that which is at the core of Web3, how does it interact with the real world? Because if it doesn't interact with the real world, there's a very strong headwind to really create tangible value. Because if everything exists in on chain and can't exist off chain, then you're just limiting yourself to what the scope of Web3 could be. So oracles just help with that interaction, right? There are various ways it does that, which I won't get into now, but it is also one very key part of infrastructure. Then you have storage, right? Just how you have databases and in servers in today's day and age of Web2, you have decentralized storage, right? In the Web3 world. Again, I won't get into how it does that, but it's a very critical part of infrastructure. And likewise, you have many, many what do you call, comparisons from Web 2 Web 3. Another one could be a computation, right? How you have AWS doing cloud compute. You have stuff like Akash Network and a few others. Even Anchor, it's ANKR, that does decentralized cloud compute. So that's another one. And then there's sorry. But yeah, so there's a whole bunch of infrastructure. There's wireless infrastructure, there's data streaming, there's identity, right? Identity is huge. But yeah, indexing, right? Data retrieval. How do you make access the data not only accurate but also efficient, right? So this is where like stuff like graph protocol comes in, just super interesting. But yeah, so that's I spent some time here because it's very important to gauge where you are in when you are analyzing a protocol. So you avoid the noise and just really focus on the signal. But yeah, so now you know what the protocol is doing, where it fits in. Now you should really go on to how is it achieving what it's saying it's going to achieve, right? So here it's a good this is the stage where I like to really make diagrams, visualize the user experience. Now the user can be you and me. It could be like the end consumer, but it also could be developers who are using infrastructure protocols. How would their experience be, right? So just creating diagrams like a what are they called, a flow diagram, right? This could be this is a good time to make those, right? Of course, then what blockchain is it built on, because that usually has a lot of bearing on what an application on that blockchain can achieve, right? So just an example on this: if you're trying to build a game, right, on Ethereum, that usually won't make any sense because Ethereum has a limitation in terms of how many transactions it can handle in parallel, which is essential for any game to really succeed, right? So here, if you find a game building on Ethereum, that too Ethereum's base layer, right, not a layer 2, it's a red flag right there, right? So that's one example. But yeah, so just understand how it's going about the problem. Then of course you can go on to the more traditional thing when you're evaluating any company, right? Because at the end of the day, this is how you would evaluate even a Web3 protocol, right? You have the market landscape, right? What is the size of the market? Of course, you won't get hard numbers, but you can gauge, right? If it's a very core infrastructure protocol like data retrieval, then you know every single application needs it, so you know it's going to be big, right? You don't have to spend too much time cracking your head on this, but it's good to have a sense of how large it can get given, say, the valuation it is at today, and that can help you gauge how overvalued, undervalued the protocol in question is. So you have that. So then you have the competition, right? How saturated is the market, right? Is it early? Is it late in terms of maturity, right? Where is the market in question in its life cycle? And of course, here as another side of the same coin is what differentiates this protocol in question over the rest of them, right? This is something that's quite important. I mean, you can ask, dinosaurs of the investing world like Warren Buffett, right? What is the moat? What is the moat here, right? And this is exactly what you would be asking yourself at this stage of your research. Of course, it's an ongoing process as you evaluate, but this is where you should at least start thinking of what it could be. And then lastly, what I'll finish on is the team, right? In any early stage evaluation of a company, or I mean, any evaluation of a company, but more importantly at an early stage, which is where Web3 is at, team is very important, right? Who is the team that is at the core of the operation and the destiny of this protocol, and as well as the backers. Because the backers is really who most likely have had access in person to these people, right? The core leadership of the team of the protocol, and whereas you're not going to get in most cases access to the team, right? You're not going to have a conversation with them, so it's a proxy to use what backers, who the backers are, right? Because if let's say a Coinbase or a A16Z has backed a project, and that they've done their due diligence to a certain degree, which could give you comfort. Whereas if some unknown venture capitalist, or let's say no venture capitalist, has backed a protocol, doesn't mean it's going to fail, but also that uncertainty is there, right? And of course, in terms of team, you should always look at what the team has done in the past, if they've had any good projects that have succeeded. Again, these are not binary things, but it's good things to keep in mind. And yeah, I think that wraps my 2 bits on how you'd go about at the very first stage of evaluation of any protocol. Guys, anything I've missed?
I can go first, but I think that was a pretty good description of what you need to look at least from an initial high level stage, right? What I'm going to actually do right now is try and get us to visualize a bit of the Web3 stack that Sid talked about when he mentioned the infrastructure layer and how the blockchain web stack is actually constructed. And I'll just paste the diagram here into the PowerPoint that I had done around what the Web3 stack actually look like. So let me just do that. Give me 1 second. Oops.
Yep, I can just jump in. Basically, what Sid is trying to do, I'm just going to summarize. He's trying to categorize whatever protocol we're looking at, right? So you just need to understand in a way where it's positioned in the market relative to the other people, and the main thing you need to understand is how exactly it works and how exactly it's transferring value between the different stakeholders. And that's like the basic thing you need to understand when you look at any protocol, right? It's just who are the stakeholders and how are they creating value for each person, the stakeholder ecosystem, essentially.
Yep, exactly. And so here I've just, I pasted a diagram that I had done around the Web3 stack previously. And, every protocol that you're going to analyze, well, most of them, because you don't want to, put something in a box and be rigid around it. But a lot of the protocols that you're going to analyze are going to be within this Web3 stack. So the bottom layer is the one that is it's the protocol layer. So it's what everything is built on top of, right? Then the infrastructure layer allows developers to access tools. It allows connections between different types of blockchains, as Sid mentioned, around the indexing and data retrieval, oracles, decentralized storage, etc. And the infrastructure layer is the one that also has to be decentralized in order for the entire stack to be decentralized. None of these, if you have centralized points of failures in this stack, you're not actually going to get the decentralized Web3 experience that we've spoken about. So the infrastructure layer right now, that's why it's of great interest. It's gone into the mainstream as well. Then you have all the applications that we love to use. It's around gaming, DeFi, etc. And then you have the user interface and access layer that users can use to interact with Web3 protocols themselves. So it's important to contextualize the protocols that we're analyzing, with relation to how the Web3 stack actually looks like, and understand what layer the protocol is actually trying to, the protocol is actually trying to tackle. So this is just to contextualize it a little bit. I think another thing that's important to analyze at a very high level, although obviously we get into that a little later, is all the areas that Sid mentioned. You have to put them in context of where you think the industry is actually going. Do you think, for example, that oracles are going to be important? If you do, you need to place it in context of, okay, so this trend is important. There are not that many players in the market that are doing this. Why does the project that I'm assessing have a leg up against competitors, and why is it fulfilling a need in the market, and how is that overall trend going to grow? So you have to kind of step back and look at the specific area that the protocol or the project operates within, and look at it from more of a macro perspective, and go from there. See if you actually believe in the area see if you believe in the problem that the project is trying to solve, and that is step number one.
Right. Another thing, I like to think of it this way. If you're looking at a protocol, you should see if they've done any kind of first principles thinking. Is there like a 0 to 1 step up in what they're doing compared to other people? Because most crypto protocols usually are forks, or they're built from other protocols, and they just kind of edit it in a small way and release it as a new protocol, but there's no real new innovation happening there. So one of the main things I would look at in a crypto protocol is whether it's creating something entirely new. And if it is, then it'll be the first to market, and it can establish that competitive advantage. So like a great example would be something like Uniswap, right? There's unlimited number of forks of Uniswap, but because Uniswap was first to market, it was a genuine, 0 to 1 invention. It captured those network effects a lot earlier than other protocols that it forked out from Uniswap, and is still the number one DEX today for exchanging ERC20 tokens. So yeah, I mean, that's a very important thing in my mind to look at.
Exactly. And like another example, you could give is kind of the layer ones, the layer one war that is going on right now. Like if you see every VC and their son and daughter is trying to fund a layer one protocol. Now, what is so obviously, like I'm not trying to diss the technicality and the technical improvements some of these protocols make, because obviously when you're trying to build something from the ground up, there are so many, trade-offs that you make, and obviously, you have different configurations of trade-offs that L1s can make. But the thing is that a lot of these L1s, if you actually look at the activity happening on it, what's created? You create an AMM, an automated market maker. You create a DEX. You create, some sort of NFT marketplace. You create a bunch of varieties of the same types of protocols that are offered on other chains. So is that real innovation? Are you trying to just, are you trying to diversify your portfolio across the same concept? Like, are you going to invest in every AMM that there is? Are you going to, are you just investing in an AMM on a new layer one protocol because you think that the price of that token is going to pump? What is the actual reason for you investing in the same thing but on a different layer one, right? And if you actually look at, there's a list and I'll paste the link in the description, but there's actually a comparison of all the different layer ones and layer twos and in the market right now. And if you keep on scrolling, there's about like 115 layer ones in the market right now. And why you need to have a solid reason for investing in these. Why exactly does that layer one, another layer one, have an edge over an existing one, and how can it grab its market share and replicate its its network effects? So when you're kind of trying to just invest in a trend and you're investing in all layer ones are going to succeed, well, that's not the correct way to think about it. You have to see what the edge one protocol has in the market above another one, and whether that edge is enough to actually sway users to use it and ditch what they're currently using. So what Yash said is completely correct. You have to actually look at the level of innovation a new protocol offers.
Yeah, absolutely. And you also then, I guess, you come back to your macro thesis of, whichever sector you're looking at. So layer ones, do you believe that there will be, several hundred chains in the future, or do you believe that, it's going to be consolidated between a few chains and we'll figure out the interoperability problem in the future between them? And, according to what, your research tells you and what you think, you can position yourself accordingly. So, personally, if you believe that, there's only going to be a few layer one chains that will, capture all the value, then, your safe bet is to just look at the top 10 chains and, figure out which is the best of them. But if you believe that interoperability will be more important than actually the chain it's built on, then you look at different solutions, and maybe, you don't look at layer ones explicitly, and you look at other protocols that help bridge different layer ones, right? So it all depends on where you think we are going as a industry in general.
Yep, exactly. Yeah, I would agree with that. Cool. Should we move on to the next one?
Yeah. So, I mean, this is a good segue. So we've been talking about, kind of subjectively about, how you look at a different protocol, but to finally quantify, come to a conclusion on your thesis, you need some objective metrics that really showcase or tell you the growth that's happening in the specific protocol you're looking at. And because it's a blockchain, it actually leads to more retention of information, which is more credible because it's all stored on the blockchain, which is what makes it in a way easier to analyze compared to, any traditional company, because it's real time, because it's constantly being updated on chain. So there are different metrics we can look at to, judge the growth of a protocol or ecosystem or whatever. So I guess I'm just going to start listing out these, different metrics we can look at, and you guys can jump in whenever if I miss something. So I guess the main thing you look at on any kind of, crypto network is the number of transactions that are occurring on the network. So, you can look at a graph and see the daily transactions and track it over time, see are those transactions increasing, is the growth linear, is it exponential? If there's degrowth, and, try and figure out why that happened, and that'll answer a lot of your questions about the protocol itself. Another metric is the number of active addresses on the protocol, which tells you it's essentially telling you the number of people who have, in a way, signed up to use the network. And if those active addresses are increasing over time, you can kind of be assured that the network is growing, and that, the growth in a way is organic, because it's not just based on hype, it's actually based on great fundamentals that are drawing people to that ecosystem. Then, from that you get transaction value, which is just an extension of transaction count in a way, but it's telling you whether the network firstly over time can handle a larger and larger amount of transactions, and whether people are trusting that network with their own money to transact on it. And that's a great metric to look at, which tells you whether people are using the network, if there's actual usage, and whether people are trusting larger and larger sums of money with that network. Then another metric to look at would be active developers. So at the end of the day, you need developers working on your protocol to grow it, to patch bugs, to improve on it, to come in and build, applications on it. And the higher the active developers you have, the more likely that network is going to see growth, because it just has more people working on it, right? And currently in the blockchain space, there's like a serious lack of developers, and there's very limited talent out there. So in a way, all these different protocols are fighting for that talent, and the number of active developers actually tells you who is winning that battle of attracting talent, because it's easier to build on it, or it has those network effects already. So more developers are attracted to it because more people use that network. So there's a higher chance that people would use the application. So active developers is a very, very important metric. And Electric Capital, the VC fund, they write great articles and reports about developer activity, which can really help guide you into figuring out what protocol is doing well long term and is actually being built on. And another metric I look at is, I guess, transaction fees paid. That's very similar to transaction value. And I guess we can club those two things together. And that's another metric that tells you how well a blockchain is doing. And then, if it's depending on what the protocol is, you can kind of look at the total value locked into the protocol. So it's a very contentious metric in a way, but it helps track the growth of any protocol over time, because value locked in basically means people kind of surrendering their whatever they are staking or any kind of value, they're surrendering it to the protocol, and they're surrendering it to this protocol rather than any other protocol, which means that if the value locked in is growing over time, that means that people are trusting that protocol to grow their earnings, or trusting that protocol to increase their wealth over time. And to do that, the protocol needs to be fundamentally well designed to create that long-term wealth which people are looking for when they lock in value into any kind of DeFi ecosystem. So total value locked in over time is crucial metric that people need to look at. And then we can look at a little more not as objective metrics that really are on chain, but social media presence, Discord channel activity. You go check out their Twitter page, for example, and see how much they've tweeted, what do they tweet about, are the founders knowledgeable, what kind of culture are they cultivating online, is it toxic in a way, or are they inclusive? You look at the number of Medium followers they have, the posts they've written, whether you think the founders are up to a certain intellectual standard, and whether they know what they're talking about. So yeah, those are just a few things you can look at yourself and see whether that growth is organic. They've been around for a while, they've been tweeting for a while, growing their followers organically because the protocol genuinely makes sense. And there's lots of red flags which you can spot even over here. Like, for example, if a protocol only has maybe 10, 15, 20 tweets, but they have 100,000 followers, you can clearly tell that growth is not organic, right? They've in some way bought those followers or got people to follow their protocol using inorganic growth, which is not a great thing for a protocol. And then I guess we can get to financial metrics. I guess your total value locked in is kind of included in your financial metrics, but financial metrics is essentially things like the market cap of the cryptocurrency. So that can tell you, whether it's a top 100 or it's a lower cap crypto, that'll give you an idea of how risky it is to invest in that protocol and whether it's reached a certain scale or not. Then there's circulating supply. So I guess Sid is going to cover this later, but usually tokens for a crypto protocol are released according to a certain schedule. So the circulating supply tells you how many tokens of that particular protocol are actually in circulation that you can go and buy and sell for yourself. And that will bring us to the fully diluted value, which tells you what the maximum circulating supply of the crypto will be times the current price. And that's a contentious metric because what you're basically saying is that if you released all the tokens and they held the current price, that would be the fully diluted value of the cryptocurrency, which is not exactly accurate, right? Because anything could happen while those extra tokens that aren't on the market get released. So, you have to kind of take this metric with a grain of salt and see whether the market cap and the fully diluted value are comparable or whether, they're completely off base from each other. That'll also give you an indicator of, where the protocol is in its life cycle in a way. Yeah, and then there's other things which you can look at, which are trade volumes and liquidity. That just tells you how deep the market is for that particular token. And, if you take up large positions in these tokens, it's an indicator of whether you'll be able to exit that position in a safe way or whether you'll have liquidity constraints and, you will affect the price of the token itself if it's too small a token. So yeah, these are, I guess, a bunch of technical metrics you can look at to analyze the growth of any cryptocurrency. And yeah, so what do you guys think? Do you guys think I've missed out or anything? Or
no, I think you've covered it in pretty much good depth. I think there's a couple of things that I'd add just so it's helpful for folks to know where to find some of these things. So for financial metrics, a lot of them you can actually find on CoinMarketCap. For liquidity, for example, if you go on, if you go on CoinMarketCap and look at the markets it's on, you can judge how liquid the supply is. So CoinMarketCap actually gives you an indicator of, the liquidity on each market that the token is listed on. Then I think there's actually a pretty good link that I'll paste in the description again of, assessing the relevance of fully diluted value, because it's if you look at fully diluted value, weight its importance in whatever model you're trying to build, or just in how important the metric is actually considered in your analysis of the token. Because again, right, the price of the token, it'll be a miracle if the price of the token stays the same. If you release all of the supply on the market, you will completely destroy its liquidity. I mean, it'll have so many effects if all of these tokens are just dumped onto the market. So it just doesn't make sense to have that assumption. For the total value locked, also what I would add is look up DeFi Pulse or DeFi Llama. Those are two of the best resources that you could use to assess total value locked and a whole bunch of DeFi metrics. I think it's in general, I think Yash, you covered almost everything to a good level of depth. Like what I would just add is that pay attention to the non-quantitative fundamentals as well. The number of social media followers, the medium followers, all of that. In the Web3 space, I think these things are a lot more important, because you're actually trying to build a community. You're trying to a lot of these projects are trying to build from the ground up, and how they engage people, and how people respond to their presence online is extremely important. So don't dismiss that as, oh, it's not really as important as its metrics, because the financial metrics will, you can kind of see trends in the financial metrics if you actually look at the non quantitative metrics as well. They interplay with each other. It's very important, and don't disregard that. But I think overall, we've covered quite a lot.
Absolutely.
I would like to just reiterate two things, and maybe I'll also help summarize this discussion that we just had. So first is definitely how I like to at least club these metrics into their into respective categories. So the first category that at least I like to think about it is the business metrics, right? So these would include the first batch of statistics that Yashi mentioned. So the likes of transaction count, active addresses, transaction value, so on and so forth. So this really tells you about how the protocol is doing, the business performance, if you will, right? The second bunch would be the community metrics, right? So these would be the social media activity. This could also include just blog posts on their on the protocol blog, on a Medium or whatever, right? So this is also important because it, like how Sid just touched on, that they're also building community, and community is in a way the product management, what product management was of Web 2, right? So if you think about it, Web 3's product management is everything that product management was plus community development. So this also gives you a very important set of metrics to consider. And last year, I would club the last bunch of metrics as valuation metrics, just to help you gauge an investment, right? Because without any investment, any company at the wrong valuation is really not a good investment, however good or important the protocol is, right? So these are the three broad, mental models I would approach the metrics we just discussed with. And this, secondly, what I would like to reiterate is, why are you looking at a particular metric, right? There isn't a right or wrong answer as to what transaction count is better, because if you think about it, for a application like a trading deck, like say like something like a Radium on Solana, probably a higher transaction count is more important to you than transaction value at the current stage, right? Whereas for something like an Aave on Ethereum, maybe transaction value is more important than transaction count. So it's very dependent on what the context you're looking at the metric in, which really, which helps you not get lost in the numbers, really, right? And another example of this would be probably social media, right? A low social media following or whatever could mean that the project is just not doing good. It's not being able to build community, but it could also mean that it's just underappreciated, it's undervalued, right? So keep in mind as to why are you looking at a number within the broader context of things. That will help probably give you direction in the ambiguity of such metrics.
Yeah, cool. I think the best thing you could do with these metrics is try to kind of compare it to the closest comparables of that protocol, right? That'll give you very clear trends, indicators about whether it's underperforming or overperforming, or it's in line with expectations. Because as it on its own, these values that you're looking at, they don't really make much sense unless you have some kind of base to compare it to. So you should always look at these metrics in a relative sense also, because otherwise you don't really get any kind of idea of whether it's growing faster than it's supposed to or slower than it's supposed to or whatever, right?
Exactly. Cool. So I think with that, we'll move into the next thing that we need to analyze, and that's actually the tokenomics of the protocol. So what I'm going to do is I'm again going to copy this, and we'll assess the tokenomics. And what exactly do we mean by tokenomics, right? So to me, tokenomics is the way that the incentives of all of the stakeholders involved in that protocol are aligned. So what the beauty of tokens, and it's why I particularly I'm excited about this entire space, is because tokens allow projects to fully align the incentives of all of the stakeholders on the or who use the protocol without needing a trusted central party. And the way that incentive structures work. So for example, I'll take the example of one of my favorite protocols, and which is the graph. So the graph is as we saw in the Web3 stack, the graph is in the infrastructure layer. So it's an indexing and querying protocol. So what it does is, so it allows, indexers. So the consumer. So there are four types of stakeholders. There are indexers or the node operators, the consumers who pay the indexers for queries, the curators who use graph tokens to signal valuable subgraphs to index. So subgraphs are open APIs that are queried with the standard GraphQL API, and delegators who stake graph tokens on behalf of indexers to earn a portion of indexer rewards. So what happens is that developers, there are a bunch of peer-to-peer indexing nodes. So developers query the P2P network of indexing nodes using GraphQL, and they verify the result in the client. So any indexers can stake graph tokens to sell their services in the query market and earn rewards for indexing subgraphs and serving queries on those subgraphs. So it's a flywheel, right? So if you think about tokenomics, it's simply a flywheel. It's where all the incentives are perfectly aligned. So consumers obtain high quality data from decentralized indexers, and and essentially you're creating an extremely competitive environment because you have a bunch of indexers who compete to provide the best prices. The indexers are incentivized to stake graph tokens and provide high quality subgraphs to gain consistent rewards over time. Delegators are incentivized to stake graph tokens and earn a higher percentage of fees from smaller, more capital constrained indexers, who they're helping to be more competitive in the market. So everyone's incentives are aligned, and that is the importance of tokenomics, right? So tokenomics is a way to structure the incentives of all stakeholders on a project. Now, there are other things that need to be essentially analyzed in terms of the tokenomics. So how does the token actually accrue value? What does it mean that why does the tokens why is this token actually valuable? So now in the example of graph that I gave, the graph token is valuable because essentially indexers earn rewards in graph tokens. They have to stake graph tokens in order to be to sell their services in the query market. Consumers pay in graph tokens, and graph tokens, signal. And graph tokens essentially, curators use graph tokens to signal valuable subgraphs to index. So that's essentially how this token accrues value. Now, if you essentially have to look at the tokenomics flywheel of a particular token to actually assess how it accrues value. You then look at another thing that is so okay, I'll just write down value accrual of the token. Then you look at the token release or vesting schedule. So this is an extremely important aspect of tokenomics, right? And essentially, so there's a really good article that's written by Cobie, and that kind of explains very easily and very simply how the vesting schedules of a token actually impact it's how the vesting schedules of a token actually impact its it's the value that the token accrues. So for example, and Cobie takes an example of a token called Casta. And so for example, for Casta, you have it's the coins are controlled by investors control 18%. The team or company, which includes advisors, ecosystem referrals, development, marketing, operations, etc. 71.5%. And retail traders get 2.5%, that is release of the market, and market makers control 8%. Then you have to look at essentially when the tokens unlock. And what, so for example, for Casta, you can kind of simplify the vesting schedule, right? So it can unlock for investors, it unlocks gradually over 1.5 to 2 years. For the team or company, it unlocks over 2 to 5 years. For market makers and retail traders, it's available instantly. So for the seed round, the prices of these tokens, because of the involvement of VCs as well, the prices of these tokens can vary. So for the seed round, the price the price was $0.015. For the private round, it was $0.022. And for retail buyers on the first day of trading, it was like around $1. So the market essentially for a lot of these tokens it will go down, because when the tokens vest over a certain period of time, right? Let's say by day 50 or whatever, there are additional market participants who have obtained that token at a much lower price, and they're sitting on some fat profits, and they want to unload their tokens. Now, when they unload their tokens at whatever the market price is, they lock in their profits, but you increase the supply of the token on the market. And therefore, you have an imbalance between demand and supply, which drags the price down, right? So it's very important to assess the token release / vesting schedule to understand how the release of the tokens and the supply of the tokens in the market is going to impact its price. And there's obviously you need to also understand what the optimal configuration of the token who the tokens distributed are to. So there's another really good article by I think it's Cooper Turley by Cooper Trooper and by Lawrence Stefanian on what an ideal token distribution schedule is. So it's important to read through that, and we'll again paste the link in the description. Another couple of things are very important to size the market. So there are 3 ways you can size the market. So you have the you have the total addressable market. So I'm just gonna paste in a few descriptions here. So you have the total addressable market, which is the overall revenue opportunity that is available to a product or service if they achieve 100% market share. No one's really going to do that. So it's just the total size of that market. Then you have the serviceable addressable market, which is the target addressable market that's served by a company's products or services. So this protocol can serve. This is the percentage of the total addressable market that this company's product and services can serve. And then the serviceable obtainable market. So this is the percentage of the serviceable addressable market that is realistically be able to be achieved. So there's quite a lot of there's quite a lot of, these 3 things are very important to keep in mind. And if you can kind of try to do different type of analyses, you can do top-down analyses or bottom-up analyses on understanding how these on understanding how to size a market. It would be very beneficial to essentially analyze the tokenomics of a protocol. And the last thing is, and this is kind of related to the token emissions, and like how those tokens actually, how does the, again, to the value accrual of the token, but is the token inflationary? So does the supply increase over time, or is it deflationary? So for example, for ETH, I think with the EIP 1559, upgrade, they started burning the fees of every time, EIP 1559 just burned all of the fees that were, essentially release in ETH when a transaction has been validated. So in times when ETH, when there are lots of transactions, ETH becomes deflationary, while when there are lesser transactions, ETH becomes inflationary. So over a longer period of time, it can be, you can kind of try and extrapolate, but when supply is decreasing over time, the price increases when there's more demand, right? So it's kind of like a share buyback in a different context. You also have to you have to also understand how the staking rewards are distributed, and whether if it's a DeFi protocol, or even actually not even DeFi anymore, does it own its own liquidity, or is it doing liquidity mining? Like for example, and liquidity mining, it's a lot of the tokens that did liquidity mining in the DeFi in DeFi summer in 2020 have significantly lost value, because they've just kept on inflating their supplies. And protocol owned liquidity, even though the Olympus DAO spectacularly crashed a few months ago, they did provide an important way to grow a protocol's treasury and actually own its liquidity, so that and actually properly and provided a map for how protocols could potentially utilize their treasuries. I mean, there was a lot of things wrong with Olympus DAO, but the model that it pioneered is an important one for the DeFi space. So and for the actually like the Web3 space. So yeah, these are a few things that need to that you should look at when analyzing the tokenomics of a protocol. I'll stop here. Guys, anything to add?
If I just want to summarize everything you said. So what most people don't realize or forget, I feel, in the crypto space is that price is just a function of demand and supply. So the things you've described here are essentially two sides of that coin, right? So the value accrual of the token, however it's designed to, accrue value to the token for the different stakeholders, that value accrual to the token is creating demand for that token. And, higher demand translates to higher price. And the flip side of that coin is the token release and vesting schedule. And, whether it's inflationary, deflationary, that all relates to the supply of the token and how it plans on increasing or decreasing over time. So you're essentially just analyzing demand and supply of a particular token and realizing whether it's undervalued or overvalued, depending on what you think the true demand should be for that token, or where the supply will be of that token in the time period you're looking at. So yeah, I mean, I just wanted to break it down into a very simple concept of demand and supply, which is all of these things are related to or create in a way.
I think that's a really good observation.
And I'll just add one thing to this, this conversation we just had on tokenomics, which is token utility, right? I mean, this is not a overarching concept of this of tokenomics, but it is one part of it, especially when evaluating value accrual, right? Of course, value can get accrued by many means, but it is a pretty let's say not common, but there is a logical flow when one comes to the conclusion that a token which has tangible utility will have a better or a higher value accrual to it, right? As opposed to something like a Bitcoin. I'm not undermining Bitcoin, but it's almost unlikely for another Bitcoin to exist after the first Bitcoin has already existed, right? So what is the token used for? Well, if you can wrap your head around that and get and build a conviction on the fact that okay, this token has tangible utility, then the whole idea of, or your understanding of how value will accrue to it will get so much more easier. And of course, if you understand what the token is used for, then you also then understand what the overarching protocol, what it's trying to do and how it works as well. So yeah, I just wanted to add that as well.
I mean, a token is basically a way to bring together different stakeholders and unite them towards a common purpose by binding them on all of them together with this one token and ensuring that they all act in like a collective interest so that everyone is incentivized to increase the value of the token in a way.
Cool. I think that's a really good way to
Yeah.
end the discussion on tokenomics. Perfect. So I think the next thing that I'll talk about is the governance model, right? And governance is something that I'm also extremely interested in. I've written a bit about governance in the past as well. And essentially, what governance is how the protocol is managed, right? So how is the protocol managed? How are people allowed to, how are participants, token holders, able to vote on, the direction of the protocol? And this is one of the key aspects that needs to be built out before a protocol is actually decentralized, right? So if you give and at the end of the day, it's simple. If you give your token holders as much opportunity as possible to influence the future strategic and technical direction of the protocol, then your governance model is a strong one. If you and obviously that's a very simple high level statement, and there's a lot of nuance that goes into that, right? So how are you, for example, going to incentivize people to vote? How are you going to incentivize? How are you going to make sure that a few wallet addresses that control a significant proportion of tokens? That happens with a lot of protocols. How are you going to ensure that they don't get undue influence in the strategic direction of that protocol? How essentially the holy grail of every Web3 project, or most Web3 projects, is that the founder and the founding team sets in place a structure. They define a governance model. There's traction. The project achieves traction, and then everyone can step back, and it can, because of the power of decentralization, because you have so many people who are actively influencing the future growth of the protocol. You can just step back and let it and step back, chill out, and let the protocol run indefinitely. So that's essentially what the holy grail of Web3 is, and governance is at the center of that, of achieving that goal, right? So some of the things that you need to look at for governance is, firstly, for me, one of the most important things is the voting mechanisms used. So, for example, a one token, one vote method it can put too much power in the hands of whales. There are many, and just to understand, and it's important to understand the type of voting mechanism that is used in the protocol, and assess, go on the previous governance tooling used. So for example, go on Snapshot or go on Tally and assess how have previous governance votes panned out, which types of proposals are getting the most traction, how many people are actually voting, what has, so how essentially how democratic is this, right? Like, what is the ability of an individual token holder, or of token or a bunch of token holders that are not monopolistic, oligopolistic, to actually influence the future direction of the protocol. There's so for example, in terms of in terms of the different types of voting mechanisms, there are so many different types of them, right? Like, for example, you have the one vote, one token, one vote model, where it can also be called as token-based quorum voting. So a certain threshold of voters is required for a proposal to pass. Now, what are the trade-offs that are associated with that? Will it hamper the growth of the protocol? Will it mean that some decisions just cannot be, some decisions just cannot be made because of apathetic voters? Does quorum voting just essentially delegate voting power to wealthy investors? Then you have other types, you have, and there's a really good article by Accelerated Capital that, dives into some of these. So I'm just going to, walk through a couple of them, and we'll again put the link in the description. But there's liquid democracy. So you have, an electorate engages in collective decision making through direct participation and dynamic representation. So voters can either participate directly on all issues or elect to delegate their votes to a representative. And each, so not going to go through each different type of voting mechanism there is today, but it's very important for a protocol to correctly define the type of voting mechanism it actually that is correct for its protocol, right? So it's very important to keep that in mind. Then in terms of governance as well, it's important to look at from a bit of a subjective viewpoint, analyze Discord, right? Analyze Discord and how it's organized. Is it chaotic? Is it difficult to navigate? Is it preventing people from engaging with the protocol? Is it is onboarding difficult? All of those things are very important. And I think it was a few months ago, but Uniswap, there was an analysis of Uniswap's Discord, and how people interacted with each other, and like how chaotic it was, how the channels were organized, etc., etc. And I think at this point we know that Discord isn't, everyone doesn't love Discord, let's put it that way, but it's the tool that most people in Web3 use, right? And it's integral for a protocol to actually get off the ground. So it's so in terms of that, it's very important to assess how the Discord is essentially organized and used, and what the interactions on Discord are as well. And another thing to look at is how do you actually propose improvements to the protocol? Do you have to hold a certain amount of the token? What is the impact of these on what is the impact on decentralization? So let's say for a protocol, you have to hold, let's say, $3,000 worth of tokens in order to propose improvements or even do anything, right? Is that barrier too high? I mean, it may be, like, it is, if you have to hold, so many tokens to actually be able to do anything on the protocol, it's a barrier to entry for a lot of people, and it actually like plays against the principles of decentralization. So, do you actually it's kind of a litmus test to see if the protocol it actually enforces what it says on the tin, like on the can. It says we're decentralized, but under the hood, is it actually decentralized? Again, so another, and some other things to assess, maybe, whether is governance on chain, is it off chain, is it hybrid? What are the trade-offs that each of these have? So for example, if it's off chain, you can't really look at every governance decision correctly, but do you even need to? Because voting on every small decision may disrupt scalability. So it's important to analyze all of these factors and with relation to what the protocol is actually stated to achieve, what the mission statement of the protocol actually is. So yeah, I think I'll stop the spiel on governance there, and let the others comment if there are any.
So if I can just jump in real quick, I think the main thing with governance is finding the perfect balance to create effective governance, because it can either be too centralized where very few parties have a say in the direction of the protocol. On the flip side, it could be too decentralized where it's hard to kind of take any decision really and agree on anything as a collective. So
Exactly.
Striking that perfect balance between centralization and decentralization is probably still a problem that has not been solved, and there's no perfect governance model yet that people have discovered. So I guess protocol to protocol, you have to look at what governance model makes sense for that protocol and what stage of growth they're in also. Because if it's a early stage protocol, you generally you want to be taking quick decisions and have the leeway to adjust to whatever the market needs, and that might not be possible if the protocol is already too decentralized with its governance. But if it's a mature protocol handling large sums of money or, value, then you want all the different stakeholders in that protocol to have a say with governance. So analyzing and finding that perfect balance is crucial. And governance should not just be decentralized for the sake of decentralization. It should be decentralized when it makes sense to decentralize, and it should be centralized when it makes sense to be centralized. So yeah, I mean, that's my take on it. It just, governance should be effective, regardless of whether it's decentralized or centralized. And obviously, both things have trade-offs and advantages.
Yeah.
Yep. I have nothing to chip in here. I think we've covered it all. So how about I jump into the next segment? So I think we're at the latter half or latter stages of of evaluating a Web3 protocol. So of course there are smaller things, smaller things in the sense that are still important to know, but maybe won't take as much time as the prior topics that we discussed. So this includes stuff like regulation, right? Are there in your jurisdiction or wherever really in question, what is the regulatory environment like? Right? Is it, and what is the trend, right, over time? Because usually, at least at bets in this space, you're trying to optimize for 3 to 4 years down the line, not at the current stage, right? So that is one subjective call that, and of course, then there are ways to mitigate against these risks, like setting up legal structures in different jurisdictions and so on and so forth. But this is one aspect that you would definitely want to keep in mind and be very well aware of, and have your pulse, your hand on the pulse on, because it can, one decision by a government can really, make your investment go to zero, right? And especially in an environment, in a industry like crypto, where this is much more relevant. So that's definitely one. But yeah, so I'm definitely gonna jump into summarizing this whole research. But before I do that, guys, is there any other smaller points that y'all want to touch upon?
I think it's not. Sorry, yeah, just go on.
So it's not really related to crypto, but I feel like the global macro environment is it has lots of implications for crypto, right? Like where we are in the interest rate cycle, what is the current kind of attitude towards risk on assets, because crypto is considered a very risky asset by the market. So where we are in that stage can help you position yourself accordingly also. Like, should you, hold more stable coins, or should you deploy that capital into, high conviction projects? Timing is important in crypto because, there's large drawdowns, lots of volatility. And if you enter at the right time, it could be very beneficial. So, looking at different macro factors is quite important, in my opinion, to successfully investing in crypto, along with everything else, obviously.
Yep. I'd agree with that. I think that, in terms of that as well, there's one thing that I'd say though, is that judge the protocol when you're judging it on the merit of what it is. But what Yash is alluding to is actually timing your investment into that protocol, because if you for example do a DCF on a protocol and its revenues, and you find out that the value is that the fair value is $10 and it's actually priced at and it's priced at $5, go in whenever, right, before $10. But if it's if you believe in the protocol is great, everything is it's met everything that you you want to see in a protocol, like we've discussed earlier, but then it's actually worth $10 and it's priced at like $100. Do you believe that it's going to go that much? Do you think that it's the correct time to enter? I mean, obviously this is an extreme example and just representative, but that's an important thing to yeah, timing is important, right? And the last thing that I'd just like to say, sorry, go on.
No, go ahead, finish.
No, it's a separate point, so you can go on.
Okay, I mean, I just wanted to say, like, if there are some high conviction projects out there for you, the safe thing to do in a way is just dollar cost average into these projects. So buy a little every week, and then you'll kind of smoothen out your cost basis for that particular protocol over time, regardless of what the market does. And if your holding period is several years and you dollar cost average over a year, regardless of what happened over the year, you're still getting an average cost basis, which will be, somewhere in the middle there. So it's safe in a way, and you don't need to necessarily time the market, which is not an easy thing to do.
Yep. Cool. Yeah. And the last thing that I just say is that, and this is it's just like, just gather any type of interesting information that you can about the protocol, right? Like, who are the holders, for example? What type of addresses hold this token? Are there whales? How long have they held for? And it's kind of related to the tokenomics as well, but it's kind of just try to gather as much extraneous information about this protocol as you can that can help influence your viewpoint on its direction and whether you actually want to invest in it, whether you're excited about it.
Okay,
absolutely,
great. So how about I start to wrap things up now.
Yeah.
So to end this this episode, what I'd like to just touch upon is the importance of gaining clarity of thought throughout your evaluation process, and really really focusing on the important points, right? Because there's going to be a lot of information that you come across, but it is the key points that that you should really focus on and really take your decision based off of. So here, one example of helping you in this endeavor would be like a simple SWOT analysis, right? I mean, this is a pretty rudimentary task, but it is a helpful one nonetheless, right? So just listing out and physically putting on paper or on a Word document, right? What are the strengths of that you found in this in the protocol in question? What are the weaknesses, the opportunities, the threats? So opportunities could be as simple as the macro trend. Is it fitting within a market or a trend that you foresee or has already commenced upwards, right? In terms of adoption, value, whatever it may be, that could be a great opportunity. Because in situations like that, you are allowed to make more mistakes in a manner of speaking, right? But you still come out on top. In terms of threats, we could talk about competition, right? Is it like how many other players are trying to solve for the same problem, right? And especially if they're all taking different approaches, chances are that not all will succeed. So then that makes it even more important for you to really get a technical understanding, a sound understanding of what you're exactly betting on. Another example of weakness could be maybe your team, right? If there's not much information about the team available online, or through however any primary method of research you can do, that uncertainty will always be there, and uncertainty to be there in the team is very, very critical in my opinion, right? If you're not getting confidence from the team, then at least I would personally avoid betting on. And this does not mean they have to be anonymous or not anonymous. It just could mean they've not had any past reputation, any past success stories, if you will, and also not done anything in the current protocol question if it's super early, right? So that's another example. But yeah, strength could be something as simple as how many chains is it offered on, right? If it's offered on multiple chains, then you by default have access to a greater user base, and of course then tells you about their philosophy of how they foresee the whole industry to pan out. And if that's in alignment with yours, then all the better, right? But overall, the point I want to drive home is that you need to gather your thoughts, in a very concise manner, eliminate the noise, and focus on what really matters. Of course, over time, you will learn and be able to detect what really matters. Of course, I think it's safe to say that we all three of us are in that stage that we're still figuring things out. We're super early on in this journey, but I'm pretty sure I can confidently say that, this is how you should approach it, right? To really focus on what matters.
Yep. Agreed.
Yeah, I mean,
I think
the
that's a good
point
way
of this first episode was to like just create a template which we'll use in forthcoming episodes and that you can use in general for any kind of protocol. It's just like a checklist of different things, and you just need to make sure that you've looked at pretty much everything you can before taking any kind of investment decision.
Yep, exactly. And like over the course of this podcast and as we go forwards, we're going to apply this in practice. We're going to assess different protocols. We're going to assess so the impossibly quick growing number of exciting protocols that are there in the Web3 space, right? So we just wanted to give what we're going to be doing a solid grounding, and obviously share a methodology, make it very transparent, make it very clear, as close to the ideals of transparency and decentralization and all of that as possible. So we're gonna do what we say, and looking forward to joining. Looking forward for everyone to join us in this journey that we're about to embark on.
And of course,
Absolutely.
the method that we used to evaluate various protocols are going to change. So this is by no means something that's final. What we've discussed today is very subject to change, and most likely will change and will evolve. But of course, as and when it does, we will once again bring to you the updated versions of how we think through protocol evaluation is.
Perfect. So thanks everyone for your time today. Remember, none of this is actually financial advice, and please click on please like and subscribe to Genesis Block, and see you guys in the next episode.
All right.
See you guys.
Cheers. See ya. Bye.
Cheers.